this is where I want to get in on this talk around defensive assets and the disinflation hedges, as you alluded to, and that goes a bit to the prior point I mentioned, which is that what's never really happened before in history is this unrelenting correlation in the drawdown of equities to treasuries, and treasuries really are your sort of classic disinflationary hedge. Usually, when you have high volatility in equities, again, not my opinion, when you look at actual price movement and yield movement in higher volatility periods, you tend to see treasuries do well. There's a flight to safety trade, and longer duration treasuries, at least for a moment in time, tend to be inverse to equities. Right? They tend to make you money in those periods of time. That's not an argument for the longer term aspect of the interaction of stocks to bonds or stocks to treasury in particular, but in these fleeting moments of very high risk, treasuries historically are your safe haven because treasuries have not acted as the risk off safe haven in this, what I would argue is anomalous period. Now, I'm saying all that because I want to get your thoughts, Lyn, on this idea that uh, will the relationship of treasuries reassert against equities in high volatility regimes if you are in this secular inflation environment? I would argue yes, because I've looked at it in the 70s. But what are your thoughts on sort of this idea that treasuries kind of get back to being a diversifier when it has been horrendous this year?
It's a good question. I think I'd have two answers to that. One is that if you do start to get a disinflationary cycle within an inflationary decade, then I think that relationship can reassert itself. Basically, if they're successful temporarily in causing enough demand destruction and get a recession, I wouldn't be surprised to see these mid to long term treasuries catch a bid as investors perceive them as safer than some of the more cyclical assets out there. And so I think you'll certainly have periods of time where that inverse correlation reasserts itself. But my second answer would be to zoom out and look at other markets. And for example, if you look at emerging market recessions, they often exhibit basically bonds and stocks selling off together. And that's generally because they're reliant on external capital. And that's because they often experience these sovereign debt crises that developed markets have not really experienced since the 1940s. And so I think that one aspect of this anomalous period that we're going through is that the developed world's not had debt as a percentage of GDP this high since the 40s. In the U.S. in particular, our sovereign bond markets have been very reliant on foreign purchases that have dried up, in part because the dollar is so strong, in part because of geopolitical differences. China's, kind of announced years and years ago that they were going to stop being a buyer on net, and so overall, the U.S. in particular is exhibiting emerging market-like characteristics, and that's obviously not in every way. I mean, we're not relying on external currency for one, right? So we're doing this in our own currency. So we're kind of like, if you view this as a lens of the U.S. is like an emerging market that happens to control its own currency, that makes some things less inconceivable in this environment. And so I would describe this as the first developed market sovereign debt crisis in many, many decades. And that can, of course, take different forms. I mean, you have the ECB is unable to, stop QE because you would have Southern European countries have their debt markets blow out, like Italy. Italy's been entirely reliant. There's no foreign demand for Italian bonds at these rates. And they can't, with 150% debt to GDP, they can't support very high rates. And so you've had the ECB monetizing that to try to keep spreads under control, although they can't really describe that out loud. That's why when Christine Lagarde's pressed, she always kind of defers and is unclear. Then you look at the Bank of Japan. I mean, they have 250% debt to GDP, and they're doing yield curve control, so they're pegging yields at 0.25% for the 10-year. And the United States is not doing any sort of formal yield curve control yet. And so we're having this kind of move up in yields at a faster rate than some other markets. And again, if you go back to the 40s, they did do yield curve control. So I think if they did not do yield curve control back then, you probably would have had a similar period where bonds and stocks were selling off together. Because at one point in the 40s, you had 19% year-over-year inflation, but they were just pegging the 10-year yield at 2.5% or less. And so the question, what would the 10-year have done in that environment if there was no central bank intervention? And so I think that when we look at this in the context of a structural sovereign debt problem, and we look at some examples of emerging markets, understanding their differences and their similarities, this period again is not that unprecedented, even though it's uncommon.
Yeah, no, and I will say I was tweeting that a couple times last month that the more I look at the dollar and think about some of these macro intermarket relationships, I put that tweet out and sharing the space that I think there's a sovereign debt crisis incoming. Of course, the path and sequence is what's going to matter to get there, but I'm with you on that.
It's a good question. I think obviously the answer is we can't know for sure. My base case is to see gold probably do pretty well this decade. By most metrics, gold went into a bubble in 2011 and 2012. And so it had that massive consolidation after that. And it's been in this general uptrend since, although obviously it's run into turbulence over the past year and a half or so. But as you point out, year to date, it has held up way better than stocks and bonds. And better than you'd expect from looking at real rate correlations, things like that. So there is clearly a bid for gold that is pretty persistent. And I think you would probably get a breakout if you were to have a perception of Fed capitulation, that basically that they reach as tight as that they're going to be able to get while still having inflationary pressures, just because the economy at that point is so weak. So I do think that there is a case for a gold breakout in the years ahead, and that basically we could be in what is essentially a big cup and handle pattern in the process of playing out. I also think if you zoom out, like the firm Incrementum, they're the ones that publish the annual In Gold We Trust report. It's a very good macro report, and they're kind of these big European gold bugs, but they also incorporate Bitcoin. And what they do is they have like a fund that's something like 25% gold and 25% Bitcoin, and basically it's kind of like their hard money fund, and they rebalance it whenever it gets out of whack. And so they kind of harness Bitcoin's volatility and outperformance while minimizing its downward volatility. And so if you have a basket of that, it's done pretty well, right? Because generally in these rising PMI environments, rising liquidity, Bitcoin's been a huge winner in the hard money space. I think it's taken some market share from gold. And then when you have declining PMI environments, withdrawing liquidity, that's generally gold's opportunity to either go up or at least hold up better than a number of other assets. And so a fund like that has actually done pretty well. So hard monies have done well this decade when you consider the multitude of hard monies that are out there. And I think that's probably set to continue. And I do think that we're probably going to see a gradual shift towards central bank balance sheets. They've already been increasing their gold exposure and not really increasing their treasury exposure too much in the prior years. And I think that's probably going to set to continue. And that's partly because what we saw in late February, where, Europe and the United States were able to seize foreign reserves, because if you hold foreign reserves in a foreign liability, that's not a very censorship resistant asset to hold. Whereas having self-custodial gold or diversified foreign liabilities, that's a way to reduce that single point of failure risk. And so I think that the overall sovereign case for owning gold has probably increased in recent months. When you combine that with negative real yields for most sovereign debt around the world, and still, long-term probably increasing money supplies for a lot of these developed markets, I think the case for gold's pretty strong. And I would just make sure that I wouldn't want to own gold without owning Bitcoin, because they're somewhat in competition now, and we've had this kind of, the marginal market share has shifted towards Bitcoin in the past decade. It's probably a good name for the space. Anyway, I perceive this as still being a declining PMI environment and still being in a risk-off situation. So as long as central banks are at least trying to, around the margins, tighten into what is in the data already an economic slowdown and potential recession, I think it does pay to continue to be risk off. And I think that there are still bubbles in certain housing markets, in certain crypto markets, in certain aspects of the stock market, that I still think that there's air that has to come out of some of those balloons. On the other hand, I think that when we eventually do get central banks unable to continue tightening due to the economy being so weak, while some of the inflationary pressure is still there, you can kind of see like currency devaluation could catch up to some of these prices, right? So things can correct downward, or they can correct sideways in time. Different markets tend to do that differently. Housing markets tend to be less volatile, so they when they correct, they tend to correct sideways unless they get to truly bubble valuations like we see in some of these countries and some of these markets. A general trend I've noticed is that in the U.S., our equity valuations for a similar sector tend to be higher than the rest of the world. The foreign sector has been very willing to buy our equities, whereas the opposite is generally true for a lot of housing markets, at least outside of major cities. Whereas if you look at housing valuations in Canada, Australia, Europe, Southeast Asia, China, a lot of similar properties are more expensive than you'd find in the US. Basically, the US is very equity oriented and the rest of the world is very real estate oriented. Basically, as our money's been weak around the world, we've monetized these other assets, and for cultural reasons and for market structure reasons, we've monetized different things at different degrees. And so a lot of this can be perceived as people monetizing things for lack of good money. As their money has negative real rates associated with it structurally, they go out and they store value in other things. And if you do get a period of harder money, then you do get a sharp devaluation in those other things. However, if they're unable to harden the money, then those other things can, either stay elevated or keep going up in that depreciating unit, right? So those things might go down in gold terms, but they could still go up in fiat terms if you get a persistent enough currency devaluation. And that's something you see in emerging markets. Again, going back to the whole comparison to emerging markets, where when you have recessions, inflationary recessions in those markets, sometimes you'll see their stock market and their real estate market continue to go up in their local currency terms, even as, of course, they're going down in dollar terms or gold terms, because the unit of account is what itself is being disrupted. And so I do think that there are pockets of excess that still have to come out in this market. And I still do remain risk off in general. But there are other things that I think have already been rather washed out. And I do think we're getting to a period where there are a number of things that someone can buy and own for the long term, while acknowledging that there are other pockets that are still not worth touching with a 10-foot pole.